Good morning and good afternoon to all of our attendees. Thank you for joining today's Family Office Network's webinar series, How to Invest for After-Tax Results. Presenting for us today is Gil Baumgarten, President of Segment Wealth Management. After 25 years in the brokerage business, Gil decided his client advocacy model was in great conflict with the fee-hungry brokerage ecosystem. So in 2010, he started his own fee-only RIA, Segment Wealth Management. Segment now advises on over $1 billion of client assets within a fully fiduciary model where the client's interests align with the interests of the firm. At the end of today's presentation from Gil, we will have plenty of time for Q&A, and we encourage your questions. Please use your questions chat option on the right side of your screen to send over any questions you have. And with that said, Gil, I will let you get started.
Well, thanks for having me today. You know, one of the things that we often talk about with clients is how to maximize after-tax returns. We find that many investing methodologies that clients rely on or are pitched to them by outside investment advisory firms or brokerages is in conflict with what would generate the best after-tax return. And it just so happens that those methodologies also generate much higher fees for those providers. And so years ago, almost 20 years ago, we started managing ETFs as a low-fee, tax-efficient way to build positions at my former brokerage firm. And I found that the brokerage firm really didn't like me doing it that way. They liked their 12B1 fees that they were collecting from their open-ended mutual fund sales, and they had side deals cut with all these mutual fund providers. And the firm was always harping on me that I was using too efficient methodologies that didn't jive with the firm's preferred way of doing business. Fortunately for me, I had several $100 million of client money, and I did enough business that the firm really kind of left me alone, but they would always be kind of snarky in the background because they wanted to grease the skids with their other ways of doing things. So that type of methodology I eventually found was in conflict with the brokerage methodology, and I just decided to leave the brokerage industry entirely. Took my several $100 million of client money, which is now over $1 billion, because clients look at this and go, oh my gosh, this is really the way it ought to be done. And so one of the things that we find is that transactional methodologies are what brokerages talk about to generate fees. But if you really were to buy a more static type of a portfolio, especially one that's backed by exchange traded funds, you'd find a much better compounded rate of return, much lower fees, and a much greater after-tax effect. So that's what we'd like to talk about today, is low turnover and still achieving diversification. So we're going to start by talking about the differences between ETFs and their open-ended mutual fund counterparts. So yes, here's sort of my background: 36 years in the business, left in 2010, top ranked firm in Houston by the Houston Business Journal. Last year, actually 2019, Barron's named me a top 20 ETF thought leader in America because I had been using ETFs for 20 years back when they weren't cool. Now they're super cool, but they're not super cool for all the right reasons. They're cool because they're liquid and they have low fees, but the tax effect is what most people get confused about, and I'm going to explain to you today how that works. So let's move on. So we're a fully fiduciary RIA firm. We can just sort of skip through this. We have $1 billion. We do run an advocacy related business. We trademarked the phrase more than advice advocacy because clients really want somebody to tell them what to do, but more than that, somebody who's looking out for them is really what they want. So surely there are lots of benefits of investing in mutual funds, and that's the reason why people buy open-ended funds. You get, when I talk about open-ended funds, I'm talking about the ones that have 5 digits. Like all the Fidelity funds are 5 digits, and you can go to, any number of providers of mutual funds, so I won't bore you with all of them, but when you look through the ticker symbols of them, they all have 5 digits. Those are open-ended mutual funds. They're a great way to diversify. They provide liquidity, you get professional management, you get economies of scale, but they have some tax disadvantages that are structural to those open-ended mutual funds that are very different in an ETF, and that's what we're going to talk about here in just a second. So along with the tax disadvantage of open-ended mutual funds, their fees are opaque. And that's one of the reasons why brokerages like to recommend them, because they're in cahoots in many ways. Most open-ended mutual funds carry a 12B1 fee, which is an enhancement to the internal operating expense that's sort of carved off and kept in reserve for the brokerage firm that currently custodies that mutual fund on their books. They kick that fee back at the end of the year back to that brokerage company. Mutual funds also, especially open-ended funds, also trade tit for tat. They trade research for hard dollar fees. They trade soft dollar fees. They trade order execution. They trade order flow. Mutual funds have to pay to attend brokerage functions. It's just it's a hotbed of money that flows back and forth between these brokerages and these open-ended fund companies. And the ETFs generally don't play that game at all. And we'll talk about taxes here in just a second. So too much trading inside of these open-ended funds is what leads to a lot of taxation. The mutual fund structure requires payments that cause the daily fund inflows and outflows to be out of balance. So the big problem is that because you're in a commingled fund structure, when you have $50 million worth of purchases and $50 million worth of sales in the same day, that's easy because the mutual fund company can just reconcile their books easily. They just give shares to the purchasers, they give cash to the sellers, no harm, no foul. The problem arises when you have $50 million worth of purchases and $150 million worth of redemptions that occur on the same day. So now in order to meet the 48-hour payment that's required for the people that are exiting the fund, that mutual fund's going to have to go in and do $100 million worth of sales of the underlying securities in order to meet the liquidity that's required to pay out the $150 million worth of redemptions. They're going to scrape the $50 million of the incomers, they're going to sell $100 million worth of the securities, and they're going to pay out the redemption. Well, the problem is that happens all the time. And what you'll end up finding is that over a year, it's like the waves of lapping on the beach. It is the rinsing of that capital gain through those required redemptions of the underlying securities that causes the underlying unrealized gain in the fund to be eroded over time. And it's those tax payments that people end up having to make on those redemptions that end up eroding their compounded return. So here's an illustration of what ends up happening. So let's say you put in $1 million back in 1991 and you're getting a 6% rate of return, you're getting a 2% dividend yield, and of course the dividend is being taxed at 23.8%, but the return of the corpus, the increase in the underlying securities, is rising at 6% and isn't taxable unless there's some type of an event that's occurring inside of the fund. So if you look at the gold line, that's the open-ended mutual fund. And if you look at the gray line, that's an exchange-traded fund that has the exact same rate of return, and you end up losing out on $1.5 million worth of compounding over this 30-year time period because open-ended mutual funds will have their realized gains reported on a 1099 at the end of the year, and you can see how this is going to erode compounded return. And I'm going to explain here in a minute why exchange-traded funds don't do that. So the really more important thing is that an open-ended mutual fund that is suffering from this type of accounting also loses the step-up in basis rule. Now, I know Mr. Biden is talking about eliminating the step-up in basis rule, and he's talking about making capital gains taxes higher. It's still an unknown. A lot of that, I think, is going to be negotiated away, but we'll end up seeing what happens. But under the current rules, a step up in basis where your unrealized gain is preserved, which an ETF does a fantastic job of that, and an open-ended mutual fund does not, you can see the difference. These are two lines that have the exact same rate of return, but the tax differential isn't being shown in the exchange-traded fund that carries forward its unrealized gains. So they don't distribute capital gains, and assets would pass tax-free to the heirs. Now, of course, part of this is the 2% dividend that is also being paid, and is also being taxed. We have calculated that into all of the math here. And that just means that the lower dollar number will pay $1 million more in taxes over a 30-year time period. So let's move on. So let's just show you an actual mutual fund. So on our books, we have a mutual fund. This is the affiliated fund from Lord Abbett, all stock fund. Client paid $29,500 for it in July of 2004. Over 15 years, capital gains were distributed and eroded the embedded unrealized gain. Compare that mutual funds over time to a passively managed ETF, and we're going to show you what that difference looks like. So here you have the value of the Lord Abbett fund going up to 127,000 from the 29 and change that it started with, and you're seeing what the taxes paid, which is the gray line. But look at how the cost basis is stepping up underneath that gold accumulation line, so that there's virtually no unrealized gain remaining in the fund. Now you may look at the white line and say, how come from January of 2008 till July or January, say January of 2015, there were no capital gains distributions? Well, that big downdraft in August of 2008 that's shown on this chart means that there weren't really any capital gains for it to realize. And over time, this ends up just stepping up, and it's eroding the compounded value, and $22,000 of taxes is being paid. Compare that with an ETF that, because it's structurally different, this is the S&P 500 in ETF form, which can be purchased by through a Vanguard. The symbol's VOO. This one we used as SPY, which is State Street's version. So this is the original ETF, the very first ETF issued in 1993. You look at the price of it in July, same purchase date in 2004. The $153,000 is the current market value, mostly owing to smaller fees. You'll see that the taxes distributed, the taxable income distributed, $4,400, and then $53,000 would be the current market value of the cost basis component of this, predominantly due to the dividends that were paid, which would be taxed and reinvested. And you'll see that the cost basis difference between the unit values, 153,000 versus 53,000 of cost basis, you're carrying forward after 15 years, essentially $100,000 of unrealized gain. Compare that to the one at the top again, you have $127,000 worth of market value with just about the same amount of cost basis. So you'll see that that unrealized gain is really what an ETF creates versus an open-ended counterpart. So here we have mutual fund at $124,000, and you'll see $13,000 in taxes, in fees that were paid. And compare that also to the ETF, which is much less expensive to operate. Still, you have almost $30,000 of higher profits provided in this S&P 500 fund, but in aggregate, over 15 years, only $1,200 in fees went to support the activities of the fund. Much more powerful way to compound your money, not only from a tax standpoint, but from a fee standpoint as well. So how do ETFs solve the mutual fund problem with regard to taxation? Well, it happens with something called the unit creation process. So when an ETF has that same disconnect between purchases and redemptions that created a tax problem inside of an open-ended mutual fund, the structure of an ETF avoids that. How does it do that? Well, it sheds those gains into the marketplace, because an open-ended mutual fund is called open-ended because it opens to let people put their money in, and it opens again to let them out. An ETF is a closed-end fund. So how do new units get created? There's an algorithm that's built into the system, and there are assigned participants called authorized participants. They buy in the open marketplace all the securities that's required to meet every purchase requirement. When an ETF is purchased, an algorithm that behind the scenes, you never see it, purchases those securities. They're delivered into the fund, and the fund issues new securities to that person. On the redemption side, they don't open the fund up to let activity in or out of the fund. They just simply jettison the securities that are in proportion to your redemption. They get shed into the open marketplace, they get sold, and every shareholder owns the cost basis on their units. That's quite a contrast to an open-ended mutual fund where everybody is sharing the underlying securities, and the activity of one investor affects the taxation of another investor. The entire process of ETFs creating disproportionate number of shares, like what causes taxes in an open-ended fund, all of that tax issue gets shed into the open marketplace because of this purchase and redemption process, and the ETFs therefore don't distribute realized gain. Most ETFs are also passive versus active, and there are active ETFs, and even active ETFs shed their taxable activity into the open market. But active managers in the end are seeking to be different so that they can appear to be smart, and everybody wants high rates of return, but that comes at a great cost. So they want to be different in a good way, but they charge high fees to participate in that, and they rarely succeed in achieving that excess performance, which in the industry we call alpha. All clients love to generate alpha, but managers have a very hard time doing it before they take their fee. After they take their fee, it's going to be even more difficult for an active manager to outrun his comparative benchmark. So S&P produces a report every year called the SPIVA report. And that is a report that basically looks at the entire investment management industry and shows how each subdivision of the industry is doing relative to its benchmark. So small cap value compared to the small cap value index, the S&P 500 compared to active managers that negotiate in the large cap space. That's essentially what the SPIVA report is all about. In 11 out of the last 15 years, the majority of actively managed funds underperformed their benchmark. So just think about that. How many people are out there? There are more mutual funds than there are stocks that they trade. So everybody owns the same securities. They're all swapping back and forth. And it's easy to perceive that it doesn't take much to outperform somebody because we might perceive that the world is full of people that aren't particularly smart. But in the investment management business, most everybody is smart. And so they're all swapping securities amongst themselves, and they're all charging fees to do that. Their activity generates taxes, and I think you're going to find that an open-ended mutual fund is going to consistently underperform its passively managed brethren. 67% of all mutual funds underperform their benchmark over a 3-year time period. 72% underperformed over a 5-year time period, and 83% underperformed over a 10-year time period. That means you're virtually guaranteeing yourself top quartile performance by choosing to not invest in an active mutual fund. That's before you consider the tax issues. That's before you consider the fee issues. Your likelihood of outperformance in a passive benchmark is way over 90%. The other problem that active managers struggle with is they try to convince the purchasers, investors, that their outperformance when they do achieve it was actually skill. There's plenty of data that supports the fact it was probably just luck. Regardless of asset class or style focus, active management outperformance is typically short-lived. None of the 71 top quartile mid-cap funds from June of 16 remain in the top quartile annually through June of 2020. It is more likely for a top half fund to close its doors or change its style than to repeat its performance in the top half. Just 1.6% of domestic equity funds in the top quartile as of June of 16 maintain that status annually through June of 2020. It just does not argue that the proper way to construct a diversified portfolio is with open-ended active mutual funds, which is almost always what a brokerage firm is going to want you to buy. So I've written about this in a book called Foolish. Spending 25 years in the brokerage business, I understand how they think. I understand what it is about their methodologies that don't make sense. And a lot of these same issues that we're talking about with regard to the mutual fund business also apply to the separate account business. Many of these mutual fund managers also run individual accounts for a fee as a sub-advisor to a brokerage account. This is often called a wrap account. Wrap accounts and mutual funds are much more similar than people want to admit. It's really just your own mutual fund of securities for which the manager is having the exact same transactions. And I'll also tell you, wrap account managers at a brokerage firm that also have a mutual fund on the brokerage firm's platform and run trades of the mutual fund across the trading desk of the brokerage firm, and also run trades on their SMA account, separately managed accounts, across that same trading desk, and also pay fees to be evaluated as a mutual fund. They pay fees to be evaluated by the brokerage firm as an SMA manager, and that creates a cesspool of money where there's kickbacks going back and forth under the table, 12B1 fees, trading revenues, advertising. There's all kinds of functions that are getting swapped underneath, which always drives costs higher for the end user. So I like to think that what these people have said with these are some of the accolades that the book has gotten. Foolish puts a magnifying glass to the issues that driven clients like me and advisors like Gil out of the brokerage world. Investors who are truly focused on the long term would be wise to pay attention. In the top left-hand corner, you'll see here, Tom Giacchetti wrote about 30% of the SEC's regulations. He's probably the most well-known compliance attorney in the United States. And he says he's blessed to represent some of the country's best investment managers. Very few firms have amassed and continue to manage assets efficiently as segment. We focus on efficient portfolio construction, and that's essentially what the book is about. The first half of the book is about the brokerage ecosystem and how they interact with their investors. The back half of the book is about the mental baggage that each one of us brings to a relationship that contaminates our decision-making process. And there's ample investor psychology research that's been done, and the book is a reiteration of those and how those things play out in day-to-day activity that harms investment performance. So that's essentially what the book is about. It'll be on Amazon on May the 4th. So that's pretty much the presentation, and I'd like to open it up for Q&A.
Hey, Gil, thanks so much. Yes, to all of our attendees, jumping right on into Q&A. Again, using your questions chat option over to the right side of your screen to send those on over. Gil, let's just kind of jump right into it, yes?
Sure.
Okay, so first question, aside from fees and taxes, are there any other advantages of ETFs?
You know, ETFs are optionable and they're marginable. So one of the things that you can do with ETFs is trade options on them. So you could sell covered calls against them. We use a strategy called naked put selling. That would be, imagine that you've got $1 million invested and you'd like to invest another $1 million, but you only want to do that if the market drops by 4%. You can sell an option at a minus 4% price where you could collect a premium for your willingness to buy stocks only if they declined in market value. So let's flip over those charts. The paper on the back of the monitor. Yeah.
Perfect.
So and they're also marginable, so you can actually borrow against them using them on collateral for a loan. So those be the two primary advantages of ETFs.
Okay, great, thank you. Now, with Mr. Biden talking about hiking capital gains tax rates, would that help or hurt the ETFs?
Well, on the one hand, that would help ETFs because tax efficiency becomes more profound in a 39% tax bracket versus a 23% tax bracket. But the loss of the step-up rule that he's also talking about would sort of confound the whole strategy that we're talking about today with regard to maximizing unrealized gain.
Great, thank you. Next question, what do you charge as an RIA?
It depends on client size. We pretty much have a $5 million minimum that's sort of age weighted. the younger a client is, the more apt we are to take a $2 or $3 million account. Typically, we would charge about 80 to 85 basis points. But remember, we're also not buying outside products such as mutual funds or SMA accounts. We manage accounts internally. And I don't want to leave everybody with the impression that we only manage ETF portfolios. That's really only about a fourth of our business. Individual stocks also have a place for most clients' portfolios in a low turnover methodology, which we also use as a pseudo investment index construct. So our business model is based on relatively low cost. Our accounts range from 1 million to 100 million. The $100 million accounts typically pay 35 basis points and pay virtually no other expenses. So that's just kind of the range of outcomes as to what the fee would be.
Perfect. Next question. Someone would like to know if you can walk us through the process of ETF selection and style or sector allocation.
That's a good question. So in our ETF construction process, we typically take 60% of a client's money and we make it broad spectrum based. So what do I mean like that? S&P 500, Russell 1000 value, Russell 1000 growth, those types, or QQQ, which is the NASDAQ 100, we would consider that to be relatively broad market based. We put 60% of the money in some combination of those. We do it for two reasons. They're highly liquid because they are where the greatest volume trades every day. They also have the lowest cost. SPY, I think, is 9 basis points. VOO, which is the Vanguard product, I think is 3 or 4 basis points. When you've got 60% of your money in those ETFs that have under 10 basis points in cost, you can afford to spend a little more on the other 40%. So we typically take the other 40% and we buy less liquid ETFs that are more industry focused. We're overweight to healthcare, we're overweight to biotech, we're overweight to aerospace and defense. So we will take that 40% and break it up into 6 or 8 other industry focused ETFs, and we're more tactical about that. It's less tax efficient. It's more fee inefficient because many of those ETFs are 40 or 45 or even 60 basis points. Even so, 60 basis points is barely half of what the typical open-ended mutual fund charges. So a 60-40 blend of that type of a construct with 40 basis points in the 40% and the 60% sub 10 basis points is going to yield an average cost of 18 or 19 basis points, which is a really inexpensive type of an arrangement.
Great, and you did bring up Vanguard. So is there anything else about that that's unique that you should talk to us about?
Well, just the fact that Vanguard is prohibited on many brokerage platforms, you can understand why Vanguard should be viewed very differently from how client focused it could be. My former brokerage employer would not allow Vanguard on its platform because Vanguard doesn't put 12B1 fees in their mutual funds. They don't swap tit for tat in terms of playing the brokerage game of paying to come to the meetings and running high cost brokerage trades across their platform. And Vanguard doesn't play that game. Vanguard is actually structured as a nonprofit. When you look at the cost structure of the typical Fidelity mutual fund equity, let's call that 92 basis points, and let's call the typical Vanguard fund 7 basis points. There's a reason why the Johnson family that owns Fidelity are billionaires, and there is no owner of Vanguard. Vanguard's ownership shares reside with the shares of the mutual funds that people purchase. It is a complete co-op. That's the reason why the costs are so low. Vanguard also owns a patent on a process whereby they take their ETFs that mimic their open-ended mutual funds, and they are allowed to consider the ETF another share class of the open-ended mutual fund. Well, imagine what happens now when Vanguard can take the taxable events that might be occurring on low basis stock inside of their open-ended mutual fund, and they jettison that to the accounting of the ETF. They take higher basis shares that the ETF owns in the open marketplace, jettison that back to the open-ended mutual fund. Then when the ETF transacts its business, it's shedding those low basis shares into the marketplace with zero taxable event. And the open-ended mutual fund that has taxable events now has the higher basis shares inside of it. It doesn't make Vanguard's ETFs any more tax efficient, but it does make their open-ended mutual funds more tax efficient. And Vanguard also loans securities for shorting transactions to the hedge fund community, for which they charge fees, as does every other mutual fund. But most mutual funds keep those fees for themselves as another profit center embedded in that open-ended mutual fund. Vanguard takes those fees and relets 75% of it back to the owners of the shares, and they use that to offset their fees. So you might even find that a 3 or 4 basis point fee inside of a Vanguard fund might even be zero by the time you consider that Vanguard is giving back dividends to the fund for their short transactions that they lend securities into the marketplace. Not very many fund companies do that.
Fantastic, thank you. Now, Gil, tell us a little bit about why mutual funds would be something that brokerages maybe like. Why do the brokerages recommend the ETFs?
Well, brokerages make their money in lots of different ways. We've touched on some of them today. Payment for order flow, payment by a mutual fund company to sponsor their meetings. So when Merrill Lynch has a club meeting for their top producers and 1,500 brokers show up, guess who paid for that meeting? They might spend $6 or $7 million putting that meeting on. And if a mutual fund company comes in and wants to be visible, well, that's going to cost you a $50,000 sponsorship. If you want to present your next up and coming mutual fund to those itching ears when you got those advisors there in front of you, that's going to cost you $75,000. So brokerages and their open-ended mutual fund counterparts are a little bit in cahoots because they grease the skids for one another. The other thing about it is that because a mutual fund fee is deducted from the net asset value of the units every day, you can't purchase a mutual fund today and sell it tomorrow and avoid the fee. It gets deducted every day. That means that when the NAV is declared at 3 p.m. every afternoon, when the accounting systems run the math on these mutual funds, the fee has already been deducted. If you were to walk up to an investor on the street and ask them if a no-load mutual fund has any fees, they would generally tell you no. And the reason why they say that is because they don't see the fee being deducted from their balances, therefore they perceive that it doesn't exist. And so embedded in that, the brokerages get a added bonus when they recommend mutual funds to investors because they're earning money in ways that clients don't perceive exist, and they perceive that the fees are a lot lower than they are in actuality.
Great. Now, Gil, would you say that ETFs would be the most tax efficient way to invest overall?
You know, in many ways, yes, but there's actually a better vehicle, and that vehicle is owning the subcomponents of the ETF. So very many, the vast majority of our clients own both ETFs and individual securities. Individual securities have other advantages, and the primary advantages are tax efficiency. When you have a charitable giving program, you're far better off to create we run a dividend-focused, large cap, pseudo-indexed strategy where we own 43 names. And the 43 names are selected specifically to try to match the performance of the S&P. Sometimes we outperform, sometimes we underperform, but we want it to have a dividend filter. Well, imagine what your year-end charitable contributions look like when you can go through there and pick out the Stryker or the Home Depot that we have virtually a 10x on from shares we bought in 2006. You can cherry pick those for your charitable giving endeavors, take cash, put it back in your managed account, and repurchase those Home Depot shares. Even an ETF isn't that efficient. You wouldn't be able to cherry pick the highest gainers. And imagine that you took a capital gain on something that you had sold an oil or mineral property and you needed a capital loss. Well, capital losses inside of an ETF are mixed up amongst the NAV units of the ETF, whereas you might have a large capital loss in one of those securities that would be in your dividend focus. You could sell that stock, wait 31 days, buy it back again, print the loss and rinse out the capital gain activity from your mineral sale. So individual equities have a lot of advantages over ETFs, but they don't have the simplicity of it. And so it kind of depends on the client situation, but ETFs are a fantastic vehicle, but so are individual stocks.
Fantastic. So, Gil, it looks like you were named a top 20 thought leader in America on this topic, ETFs. Can you just elaborate a little bit more on this recognition?
Well, you know, Barron's studies the investment practices of most investment advisors and financial advisors in the US, and they use some methodologies to sort of gauge what the value of the advice is that those advisors are providing. The more client-centric that methodology is, the higher the advisor's score, and the more that the advisor focuses on commissionable products, which my firm earns no commissions whatsoever, but other advisors that are commissionable are included in the list. And the more that that advisor focuses on high-cost products, such as annuities, which many advisors make their entire living selling annuities because the commissions are spectacular. And so they have a ranking system that sort of gauges what the value of the advice is from an investor's perspective. And I ended up on their top 1,200 list for the last 9 years, I think. And then they sort of looked at the fact that a very large percentage of our practice is focused in ETFs. And I write about it all the time. I write a blog. People can go to my segmentwm.com website /blog. You can sign up for free. We send out a writing that's, you know, every 3 weeks or so, and it's always about cost or, you know, helping investors figure out how to defend themselves against the nuances of the business that they might be unaware of.
Right, that's fantastic, wonderful. Now, we're already talking about you a little bit here, Gil, so tell us about your new book, Foolish, as well.
So Foolish is really just the culmination of 35 years of experience of dealing with these nooks and crannies of costs that people don't understand and taxes that people don't understand. And brokerages tend to minimize the after-tax effect of things because it doesn't feed their transactional methodology. And so back in the day, I was trained to nip client gains early, because what you don't want, Gil, is to have a large unrealized gain on your books, because clients aren't going to want to pay a fee on that, and they're going to be resistant to selling that later. And if you let that position percolate too long and become a large unrealized gain, clients are going to ask for a certificate, and they're going to put that certificate in their bank account, and they're not going to be paying fees on it anymore. Well, that conversation right there is exactly why you need to be very careful about the taxation and realized gain that's occurring in your brokerage account, because your broker doesn't get paid for the after-tax effect of it when it's highly valuable to an investor who pays attention to it.
Right. Well, Gil, that seems to be all the questions. So before we sign off, what other tips or worthy of discussing today? Maybe some positive reinforcement for us here.
Well, you know, volatility is one of those things that makes people nervous. And I would just suggest that rather than try to trade your way into profits, you should be looking at positions that you can hold for a 10 or 20-year time period. And ETFs would certainly fit the bill of something that you can remain diversified in and hang on to for a really long time period. And that 60-40 blend that we were talking about, it could be a great way for somebody to start sort of evaluating how to build their portfolio for the next 25 or 30 years and not worry about whether they're going to be able to get some Bitcoin on the cheap or whether GameStop is where it's all happening right now. That's not really what portfolio construction should be focused on. So that'd be the #1 tip I would give people. And go buy my book.
Yes, exactly. And actually, Gil, can you share your the blog address again for everyone?
My blog is www.segmentwm, so that's Segment Wealth Management, segmentwm.com/blog, BLOG. You can sign up right there. Whatever we write will get posted there, and it'll all automatically send out an email to everybody on the list, and we'll have the blog post in it.
Wonderful. Gil, you've been a true pleasure joining us today. Thank you so much to all of our attendees. Again, my name is Lindsay with Family Office Networks. I'm going to be following up with everyone individually, so if there's any additional questions that you have for Gil, I would love to introduce you. We hope you have a great day. Thank you so much.
Thanks for having me.